If I were at the Treasury Department right now and gold's at 4,000, I could revalue gold today, our certificates of gold today, and buy a little bit of time, get $1 trillion plus in gold and basically QE gold, use that revaluation to get some money to buy some US Treasuries, take $1 trillion off the table. But why not wait till gold's at 8,000 or 10,000? You don't have to revalue gold at a new floor of 10,000 or even 20,000. It'll get there on its own, and then you can revalue your certificates then. I think they're just going to wait until gold's at a higher valuation. There's actually, ironically, a vested interest for the U.S. Treasury Department to see gold run, to let gold run, because when it's at a higher valuation, that's when they're going to decide to hit the button and revalue their certificates. They're based at $42 right now. So those 260 million ounces will have a lot more value revalued at 10,000 or 20,000 or higher than they will at 4,000, 5,000, or 6,000. And I think they know that gold can go that high.
Matthew Piepenburg, a respected macro strategist and partner at Matterhorn Asset Management, recently explained why the U.S. Treasury may have a hidden incentive to let gold prices rise dramatically. He noted that the Treasury still values its 260 million ounces of gold at just $42 per ounce, a relic from decades ago. By simply revaluing that gold to market levels, say $8,000 or $10,000 per ounce, the Treasury could instantly create trillions in new liquidity without issuing fresh debt. This QE through gold strategy, Piepenburg argues, would allow the government to stabilize the bond market and buy time amid mounting fiscal stress. For now, he believes officials are deliberately allowing gold to run higher, waiting for the perfect moment to reset the system with maximum leverage. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
We're talking about gold revaluation. To your point, the Fed can revalue its gold certificates to market today, or it could, to your point, have the Treasury and the Fed offer a bid to market at a higher price than spot and make a new floor in gold. I think there's a number of reasons why that's inevitable. I know that the head of the Bank of America said it's inevitable. The question is, inevitable doesn't mean we can time it. If I were at the Treasury Department right now and gold's at 4,000, I could revalue gold today, our certificates of gold today, and buy a little bit of time, get $1 trillion plus in gold and basically QE gold, use that revaluation to get some money to buy some US Treasuries, take $1 trillion off the table. But why not wait till gold's at 8,000 or 10,000? You don't have to revalue gold at a new floor of 10,000 or even 20,000. It'll get there on its own, and then you can revalue your certificates then. I think they're just going to wait until gold's at a higher valuation. There's actually, ironically, a vested interest for the U.S. Treasury Department to see gold run, to let gold run, because when it's at a higher valuation, that's when they're going to decide to hit the button and revalue their certificates. They're based at $42 right now. So those 260 million ounces will have a lot more value revalued at 10,000 or 20,000 or higher than they will at 4,000, 5,000, or 6,000. And I think they know that gold can go that high. Many say that's pie in the sky thinking. When we saw Bitcoin go from 10,000 to over 100,000, that wasn't shocking because no one took it seriously. If gold went from 10,000 to 100,000, that would be scary because the world's stacking gold, the central banks are stacking gold, and he who has the most gold wins. It's a longer conversation, but I think they're going to wait until gold's at a higher valuation before they revalue gold because it's one and done. You don't want to do it at 4,000 or 5,000 if it's going to be 10 or 15,000. And eventually in our lifetimes, Elijah, I'm quite confident it will be. Not because gold gets shinier or because gold gets more headlines because there's more jewelry or wedding rings or dental fillings. It's because fiat money across the spectrum is just losing value versus gold because it can't be created ad nauseum like paper money can, and it holds its value better. Central banks hold more gold than they hold U.S. Treasuries. And even Judy Shelton wants to issue a gold-backed U.S. Treasury at the long end. Why? These are just open and obvious signs that the world is turning away from a debased dollar, a debased greenback, still very powerful, we can talk about that, but they're saving in precious metals because it holds its value better than paper money. We can't say it enough. There's 5,000 different ways to say it. We can't say it enough. This is not a gold bug case. This is a macroeconomic shift. This is a major shift. It's not the end of the world reserve currency, certainly not yet. It's not even the end of the dollar, but it is a massive shift from the petrodollar to the U.S. Treasury markets, to the gold stacking of central banks, to the BIS making it a tier one asset. What more evidence do you need that there is a shift here? So again, goes back to whatever the gold price does today or tomorrow is really irrelevant in the larger scheme of the direction it's going. And people think that maybe this is the end of the bull run. Again, I have my bias. This is chapter 1 of a very long novel, maybe chapter 2 for the direction of gold. And it's easy to get seduced by certain headlines. I mean, even during Weimar, when you started to see wheelbarrows of money, every now and then there'd be a headline saying, the Versailles Treaty has been amended, our reparations are going to go down. And people would actually start selling gold and buying more Reichsmark. Within the next 2 or 3 weeks, the currency was getting slashed by 200-300% or doubling every 2 weeks. They thought that the problems are over. The problems that gold is an anti-fiat solution to, the problems that gold is solving or basically doing nothing but hold its value while the rest of the world devalues, those are not going away just because there's a $150 move in the gold price during this particular day, up or down. These problems are so endemic to the global macro system and the global financial system. Again, long answer to a short question, Elijah, but no, these price moves don't faze me because I hold gold for decades, not for weeks or months. I don't trade them. I save in them. The 1,000+ clients that we have from 90 different countries are doing the same thing. And any gold investor right now understands this perfectly. It doesn't faze me in the slightest.
Matthew Piepenburg explained that a U.S. gold revaluation is not a matter of if, but when. With Treasury gold still officially priced at $42 an ounce, he noted that every $1,000 rise in gold's market value represents trillions in potential liquidity. By letting gold naturally climb toward $10,000 or higher, the Treasury could eventually cost e-gold, revalue its holdings, and generate massive capital without creating new debt. This, he said, aligns with the global trend of central banks diversifying away from treasuries and stacking gold as the ultimate reserve asset. Piepenburg stressed that short-term price fluctuations are meaningless in the face of such a macro shift. Gold is not speculation, it's preservation. Let's get into the interview.
Well, it's a very important question. And of course, I can't just say, well, don't worry, gold and silver will only go secularly up and there's nothing to worry about, no major pullbacks. Yes, of course, there are pullbacks in bull markets. I still believe that. And I absolutely believe that the world in 2025 is very, very different than the world in 2011 for all the reasons we just went over. Again, from the BRICS to the de-dollarization, to the tier 1 status, to even banks like Morgan Stanley recommending 20% gold allocations, to the obvious movement by central banks to prefer gold over U.S. treasuries, Judy Shelton, et cetera. So the world in 2025 and that tipping point, that pendulum swing to real money versus fake currency or paper money is very, very on the minds and very conscious of the central banks and the policymakers of the world, much more so today, post-2022, than it was in 2011. So comparing gold and silver's moves in 2025 is very different than in 2011. So all the reasons I see gold in a bull market, silver will outperform gold in percentage moves, both to the upside and the downside, depending on the volatility. But in the long run, silver will be significantly higher in the future than it is today if you're holding it for the long term. But it's important. That's my view. That's my conviction. To those who would say Piepenburg is possibly selling his book, his dollar case is intelligent, but it might not necessarily be correct. These are important things. I want to make it very clear that there are cases where the dollar could have a last dance, as Henrik Zeberg said, or as in certainly the Brent Johnson, the milkshake theory, he thinks the DXY could go to 130. Could that mean a weaker gold and silver price? Could Matt Piepenburg's thesis about the macro environment in 2025 being so different now that maybe gold and silver are at some risk and his secular arguments are too optimistic? You got to at least look at that, right? I mean, again, I have said that devaluation is nothing new. I have said that the debt levels today are very different than 2011 or even 2008, and that the world is proving itself with its central bank stacking and with its preference for U.S. dollar or U.S. treasuries. It's proving that this time is a very new cycle, not different. It's just a new part of the cycle, that it won't be behaving like prior pullbacks. And the strong dollar case by Henrik Zeberg in particular is that, look, Matt, you can say all these things you want about debt and how ugly the dollar is. Brent Johnson would agree how ugly the dollar is, but the DXY is going up because in times of real stress, that's still the safe haven. First of all, running up into 2025 is very different than the run up into 2008. And the world is very much showing us their hand, so to speak, and that is the world is already preparing for some type of mean reversion in the market, some type of credit crisis, some type of uh-oh moment in the S&P. It may or may not happen, but if it did, The life wrap the world is already showing itself to go to is clearly precious metals and not the US dollar or the US Treasury. Again, if you look at Treasury auctions, if you look at the net dumping of US Treasuries and the stacking of gold, if you look at what the BIS is doing, what the IMF is doing, if you look at what central banks are doing, if you look at the fact that, central banks now, as of this, again, recording, own more gold and hold more gold than US Treasuries, that if Zeberg, for example, and many like him say, if the market crashes, that the world's going to go to US Treasuries and the US dollar as a safe haven, I would argue that that is not going to be the case because it's already not the case. The world's already turning its back on the US 10-year, the US 30-year, the US Treasury, and stacking gold. So if there is a mean reversion, moment, as Zeberg predicts, and he could be right, in 2026, 2027, or tomorrow afternoon, that the world's not going to react the way it did in 2008 because they're going to go to gold more than US Treasuries. And so you won't see a spike in the DXY and you won't see a 30% retracement in physical gold. Now, again, that's just my view. He's arguing that history repeats itself or history rhymes and that the next market crisis will be very similar to the case study that was the great financial crisis. Again, I'm saying that's not necessarily the case. The world's already moving away from the safe haven of the 10-year and the dollar to physical gold. But, even if there were a spike in the DXY, even if there were a safe haven run, as Zeberg says, in the next market moment, I actually agree more with Brent Johnson, who also sees a stronger DXY if there's a crash in the markets. If you're holding gold as a strategic reserve asset, as a store of value, and you buy it at 4,000, 3,000, or 4,500, if you're holding for the long term, if you're thinking about the legacy, if you're thinking about the purchasing power of your actual real money, if you're thinking about your kids and your grandkids in safety and whatever may come, if you're holding gold for the long run, even those who see a retracement in gold certainly do not consider this the last dance for gold and see it in the much, much higher valuations. So I wouldn't be worrying about a pullback to enter this market. Again, I'm agnostic whether you come to my office or not, but I don't want clients to not buy gold because they're waiting for a pullback. And I'll close with this. When Henrik and I were in South Africa in February of this year, he was saying the same thing, 30% chance pullback. At that time, gold was at 2,900. So a lot of listeners might have thought, well, if Henrik says 30%, I better not buy now. I better wait for the pullback. You fast forward today when gold's at 41, 4,200. Even if we had a 30% pullback today, gold would still be higher than it was in February. So if you were waiting for that pullback, you were chasing the wrong goalposts. I'm saying trying to time this market as a gold investor for the long term is a fool's errand. I don't know what the gold price is going to be tomorrow or the day after tomorrow, but I'm very confident where it's going to be 5, 6, 7 years from now, and that is much higher than the current price. And no matter what the price of gold is, it will be certainly a stronger piece of store of value, piece of wealth measurement than fiat money, whether it's the dollar, the peso, the yuan, the Swiss franc, the euro, the Canadian or Australian dollar. That is my strong, strong conviction. That is not selling a book.
Matthew Piepenburg wrapped up by emphasizing that investors who try to time gold are missing the larger story. The global monetary structure of 2025 is not the world of 2011. It's one where central banks hold more gold than U.S. treasuries, and nations are openly de-dollarizing. Even if the dollar sees a temporary last dance, he argued, the long-term trajectory for gold remains secularly higher. The world's wealth is quietly repositioning from paper promises to tangible stores of value, and every pullback in gold or silver is simply a pause in that migration. For those thinking in decades rather than days, the direction of real money is clear, and it's not back toward fiat. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.